Simply Financial with Christopher Calandra, Certified Financial Planner, is an innovative, comprehensive, informative, and cutting-edge podcast that discusses financial topics ranging from personal finance, economics, politics, and personal growth. Simply Financial will cover intriguing and thought-provoking questions so that the listener can simply increase their financial IQ.
Welcome to the Simply Financial Podcast. I'm your host, Christopher Calandra. This is Season 3, Episode number 33. Thanks for joining me today. Last week's episode was titled The Powell Pivot, and I would urge you, if you haven't listened to it, to go back and listen to it. You don't need to listen to it to catch on to today's message, but I think I know they pair together quite a bit. Last week's episode was The Powell Pivot, talked about interest rates and Federal Reserve Chairman Jay Powell's pivot to an environment where the Federal Reserve was raising interest rates and the outlook was for continued interest rate increases. And as early as the fall of 2018, that was the forecast. But so much has changed this year. The Federal Reserve and Chairman Powell pivoted to cutting interest rates in late July. And that is really important news with far-reaching implications. What we've seen since then, since last week's episode, is that this pivot on interest rates was also a pivot to greater uncertainty for the markets. And again, as of the recording of this in early August 2019, the stock market has become very uneasy. We've had a number of bad down days. There's just a lot of uncertainty. This Powell pivot definitely amped up uncertainty. Uncertainty about interest rates, about currency and currency manipulation, and about the earnings outlook for U.S. corporations. So let's talk about each of those briefly, and then I want to touch on some strategies for investors in a volatile market. So this Powell pivot has amped up uncertainty. Interest rates. I talked about this a lot last week, but in summary, for several years now, beginning in 2016, the outlook was that we were in a rising interest rate environment and it would probably be secular, meaning that it would last for a while. It was a longer term trend. And up until the fourth quarter of 2018, it seemed like that trend was in place. Now that trend has gotten erased. We had the first interest rate cut in late July. We had an interest rate cut in late July. That was the first interest rate cut since 2008. So that's created a lot of uncertainty around interest rates. With this rate cut, is it one and done and then the Fed's going to go back to raising interest rates? Is it the first in a series of rate cuts? In fact, I talked about it in the Pivot to Uncertainty episode. A lot of Wall Street and economic watchers thought that we would get a half a point cut in interest rates instead of the quarter point cut we actually got. So there are a lot of people out there expecting that we'll get another interest rate cut this fall, maybe in September and or October. We'll have to see how that plays out. Or does the Federal Reserve just do this one cut and then wait and see and nothing happens for a while, meaning that they remain pat? There's a lot of uncertainty with interest rates, and that has been unhelpful as the market has less certainty to deal with. Second thing is currency. There's a lot to unpack here, but we have this ongoing trade battle with China, and the Chinese have responded to our instituting tariffs, which is basically a tax levied on goods imported from China to the U.S. They have responded by changing or manipulating, President Trump would say manipulating their currency and getting their currency, the yuan, to weaken. And what happens when the currency weakens, that makes their goods less expensive when it's imported into another country like the U.S. What that means is China, by manipulating their currency, are trying to offset the cost of the tariffs. The president and the United States have responded by designating China as a currency manipulator, meaning that they're not allowing the market to determine exchange rates for currencies, the yuan versus the dollar versus the yen, the yuan versus the euro. And so we have this ongoing battle, some call it a war, with China over trade policy. As I said in last week's episode, I think this is something that is going to take a while to play out. I continue to be quite optimistic that a deal with China will get done, and China will ultimately make some concessions to the U.S. because they have been an unfair trading partner and have not played it straight for a very long time. I agree with the president and also lots of politicians for years on both sides of the aisle who have said that China has taken advantage of us and we have gotten the worst of our trade deals with them. So that's what's happening on the currency front. Again, that's causing uncertainty and making the market uneasy. The last thing, interest rates, currency, and earnings. The United States economy has done very well the last couple of years with economic growth higher than what we saw coming out of the financial crisis in the years from 2009 through 2016. There's a lot of reasons for that resurgent economic growth. A big part of that, though, was that U.S. companies are lean, well-led, have good balance sheets, and are very competitive around the world, and they have driven very good earnings for themselves. And that's translated in a good performance for the stock market because we've seen earnings growth and very profitable U.S. corporations by and large. With this trade battle and this uneasiness surrounding what's happening with China, as well as other trade battles that are going on, including with the EU, is will these earnings be affected such that we see an economic slowdown? Not a recession where we see negative economic growth, but a slowdown where we don't see the same economic growth we've seen the last couple of years. For example, between the second quarter of 2018 through the first quarter of 2019, we had plus 3% GDP growth. In the first quarter of this year, the GDP growth annualized was 3.2%, but in the second quarter it dropped down to 2.1%. I think, in my opinion, the Federal Reserve cut interest rates to help the U.S. economy and candidly help the administration by being accommodative. The tariffs and the trade skirmishes hurting economic growth a little bit. So by cutting interest rates, that'll help the economy a little bit. So we're trying our own offset, just like China was doing with their currency manipulation. So concerns about U.S. corporations' ability to maintain and grow earnings, which has been a big driver of economic growth and helped power the U.S. stock market to the recent highs that were achieved in July of 2019. That's kind of a lay of the land. Again, I would urge you to go back and listen to episode 32 of season 3 for more information on this. That's titled The Powell Pivot. This show, I'm pretty sure I'm going to title Pivot to Uncertainty. So let's talk about strategies for investors in a volatile market. Those of you that are clients and regular listeners, some of this you will have heard before, but it is important stuff. And we're going to be doing our monthly mailing, our monthly newsletter. We'll touch on a lot of what I'm going to touch on, although it'll be more brief here. If you haven't signed up for our newsletter, go to our website, elliottwealth.com, and you could sign up for the newsletter. It's free. Some strategies, though. First off, keep perspective. According to Guggenheim Investments, the S&P 500 has had declines of between 5 and 10%, a total of 78 times since the end of World War II or 1945. And the average time it took for the market to recover and get back to previous highs was about 1 month. I often talk to clients about holding your nose and walking through these market downturns, which are upsetting, they're stressful. It's not easy to remain unemotional, but it's in your best interest to do so, because looking at that historical perspective, and this time could be different, but looking at the historical perspective, the market goes down. It goes down fairly regularly, between 5 and 10%, but when you also consider how often it bounces back in roughly 30 days, that is a pretty important data point. So keep perspective. The long-term performance numbers that you see when you see that the stock market does, 8, 10, 12%, whatever it is, those long-term numbers that you see, they incorporate periods like we've seen in early August when the market sells off. They incorporate periods where the market is nervous and there's bad news and there's headline risk and there's media personalities telling you that things are really bad. It's all built into those long-term numbers. So again, I know I'm repeating myself, but you want to keep perspective because this is normal. Corrections are a part of the investing experience. Corrections on average, again, going back to the post-World War II period, so for some 75 years, or I guess a little less than that, we've had corrections, which are defined as declines of 10% or more, on average about once every 1.87 years. It's pretty common. They stink. They're still hard to get used to, even for me, that's been in the business for 26 years. But even though they're normal and they're upsetting, you do not want to take your eye off the prize, and the prize is to stay with your plan that should be consistent with your goals and objectives and your financial situation, and not to get distracted by what is normal correction activity. I mentioned the media a moment ago, and I am so much like my dad. I grew up hearing my dad rail against the media, and it was more of a political expression and not so much a financial one, but my dad always felt that the media was not serving Americans well. I believe today that is true. I believe it in the political realm. I also believe it in terms of the financial realm. The media's job is not to help you or me make smart financial decisions. Their job is to get us excited, to get us to tune in, sign in, check out websites, watch the shows, stay through the commercial break. Their job is not to help us make financial decisions. And there is a media magnification. Bad news sells, so bad news is going to be magnified. When the market goes up, they're not going to talk about it much. But when the market goes down, they are going to magnify that news, and it creates a distortion for people in my audience who are not market watchers. You're busy with your career, your business, being a good spouse, being a good mother or father, and you'll notice on the news they'll talk about the market went down 200 points, 500 points, 700 points, whatever it is. But if the next day the market's up 500, they may not even mention it. And you want to be careful not to be tricked into thinking that things are worse than they are, because the media has a different objective compared to what our objective is in working with clients, which is to help